For years, economic growth was treated as the universal solution to almost every problem. If economies expanded, living standards would rise. Debts would shrink relative to income and political pressure would ease. That assumption shaped policy across countries for decades. Recently, however, growth has returned in many places without delivering the outcomes people expected. To understand why, it's important to examine what growth is no longer able to fix. For much of the modern era, growth acted as a reset button for economic stress, allowing governments to outgrow debt, absorb social costs, and restore confidence after downturns. When productivity increased and populations expanded, rising output created room for higher wages, public spending, and private investment at the same time. This made trade-offs easier to manage. Policymakers could promise improvement without confronting difficult choices directly. Over time, however, the conditions that made growth so powerful began to weaken. Productivity gains slowed, demographic expansion stalled, and economies became more complex and interconnected. Growth did not disappear, but its quality changed. Output increased without translating into broad income gains, leaving households feeling stagnant even as headline numbers improved. At the same time, debt accumulated faster than growth, limiting how much relief expansion could provide. Governments discovered that even during growth periods, budgets remained strained and political pressure stayed high. This shift altered expectations. Growth was no longer enough to restore balance automatically. Structural issues such as aging populations, rising inequality, and higher servicing costs continued weighing on economies regardless of expansion. As a result, growth became a necessary condition for stability, but no longer a sufficient one. Markets adjusted by focusing less on growth rates and more on sustainability, credibility, and long-term capacity. Citizens adjusted by judging success through living costs and opportunity rather than aggregate output. This disconnect explains why growth can return while frustration persists. The system still expands, but it does not heal itself the way it once did. Growth now exposes underlying limits instead of masking them, forcing governments to confront problems that expansion alone can no longer solve or postpone indefinitely across modern economies today. If growth can no longer fix underlying problems, what replaces it as the foundation of economic stability? Even when economies continue to grow, the benefits of that growth are increasingly absorbed by rising costs and existing obligations, leaving little relief for households or governments. One of the main reasons is debt. As public and private debt expanded over years of low interest rates, a larger share of new income is now diverted towards servicing past borrowing rather than improving present conditions. Governments use growth to cover interest payments instead of expanding services. Companies use higher revenues to stabilize balance sheets rather than raise wages or invest aggressively. Households face similar pressure as higher incomes are offset by mortgages, rent, and credit costs. At the same time, the cost structure of modern economies has shifted. Housing, healthcare, education, and energy consume a larger share of income than in previous decades. Even modest growth struggles to keep up with these expenses, making progress feel invisible. This creates a perception gap where economies expand on paper but stagnate in lived experience. Growth no longer creates slack in the system. It barely maintains balance. This dynamic also changes policy effectiveness. Governments cannot rely on growth alone to reduce deficits because higher revenues are matched by higher obligations. Social spending rises automatically due to aging populations and healthcare demands. Interest costs rise when rates remain elevated. As a result, growth becomes defensive rather than transformative. It prevents deterioration, but does not generate improvement. Markets recognize this and adjust expectations. Investors value stability and credibility more than expansion speed. Citizens judge outcomes through affordability and opportunity rather than GDP. This is how growth loses its problem-solving role. It continues to matter, but its capacity to absorb shocks and resolve imbalances has diminished. Growth buys time, not solutions, in economies where costs and commitments rise as fast as output itself. If growth is now used just to stay afloat, how long can economies maintain stability without deeper change? One of the clearest reasons growth no longer solves economic problems is the growing disconnect between output, productivity, and wages. In earlier decades, economic expansion was closely linked to productivity gains, meaning workers produced more value per hour and were paid accordingly. This created a virtuous cycle where growth raised incomes, supported consumption, and reinforced stability. That link has weakened. Productivity growth has slowed across many advanced economies, even as technology advanced. Much of today's growth comes from sectors that are capital-intensive, highly concentrated, or reliant on scale rather than broad labor participation. As a result, output can rise without lifting wages meaningfully. At the same time, bargaining power shifted away from workers. Global labor competition, automation, and weaker unions reduced the ability of wages to keep pace with economic expansion. Even when companies grow more profitable, gains often flow towards shareholders or balance sheet repair rather than employee compensation. This weakens the transmission of growth into living standards. Governments feel the impact as well. So when wage growth lags, tax revenues grow more slowly than expected, while demand for public support remains high. This limits fiscal space even during expansion. Households experience this as frustration. They hear about growth but feel stuck because higher living costs absorb any incremental income gains. Over time, this erodes trust in growth as a solution. Productivity stagnation also makes future growth harder to achieve, creating a feedback loop. Without rising productivity, growth depends more on debt, population increases, or asset inflation, all of which carry limits. Growth becomes thinner and more fragile. The economy expands, but the foundation weakens. This explains why growth feels disconnected from progress. It still increases output, but it no longer delivers the broad-based improvement that once made it a reliable fix for economic stress across countries today. If productivity and wages no longer rise with growth, what mechanism is left to improve living standards? As growth lost its connection to wages and productivity, inequality quietly reshaped how expansion affects society. In earlier periods, growth lifted a broad base of households, spreading gains across income levels and regions. That distribution made growth politically and socially stabilizing. Today, growth is far more uneven. A larger share of gains flows toward high-income households, asset owners, and large firms, while lower and middle-income groups see limited improvement. This concentration changes how growth feels. Even when economies expand, many people experience little progress, making growth appear abstract or misleading. Asset-driven growth amplifies this effect. Rising stock prices and asset values boost wealth for those who already own them, while renters and younger workers face higher barriers to entry. Growth increases measured wealth, but deepens gaps in opportunity. Governments struggle in this environment because inequality reduces the effectiveness of traditional policy responses. Stimulus and expansion raise asset prices quickly, but translating those gains into broad income growth is slower and uncertain. As a result, growth fuels frustration instead of relief. Political tension rises as different groups experience the same economy very differently. Those benefiting from growth push for stability, while those left behind demand intervention. This tension makes policy more contentious and limits consensus. Over time, inequality weakens growth itself. When a large share of income is concentrated, consumption growth slows because high-income households spend less proportionally. Investment shifts toward financial assets rather than productive capacity. Growth becomes less inclusive and more fragile. This is why growth no longer resolves social and economic stress the way it once did. It can coexist with rising dissatisfaction, political polarization, and declining trust. Growth still matters, but its distribution determines its impact. Without addressing inequality, expansion cannot restore balance. It may even intensify the pressures it once helped resolve, leaving governments facing unrest despite positive headline numbers across economies worldwide today. If unequal growth increases frustration instead of stability, can expansion alone ever restore social balance? One of the less visible consequences of modern growth is that it no longer expands government freedom the way it once did. In earlier periods, stronger growth automatically improved public finances. Higher incomes generated more tax revenue, deficits shrank relative to GDP, and governments gained room to invest or reduce debt. Growth acted as a release valve for fiscal pressure. Today, that mechanism is weaker. Even when economies grow, government budgets remain strained. Rising revenues are absorbed by higher debt servicing costs, aging-related spending, healthcare demands, and social obligations that expand faster than output. Growth stabilizes finances but rarely improves them. This changes how policymakers think. Expansion is no longer a path to flexibility, it is a requirement just to maintain balance. As a result, governments cannot wait for growth to solve structural problems. They face pressure to make hard choices even during expansion, something political systems are not designed to do. This creates tension. Voters expect improvement when growth returns, but governments often respond with caution, explaining that resources are already committed. That disconnect fuels distrust. Markets recognize this constraint as well. Investors no longer reward growth alone. They look for fiscal discipline and credible long-term plans. Countries with solid growth but weak finances still face higher borrowing costs. This reinforces caution and limits ambition. Growth becomes defensive. It prevents deterioration but does not restore capacity. Governments shift from using growth to expand options to using growth to avoid crisis. This is a fundamental change. When growth no longer buys freedom, policy becomes about managing limits rather than creating opportunity. That reality reshapes political debate, public expectations, and economic strategy. The challenge is not that growth is unimportant, but that it is insufficient. Without structural reform, productivity gains, and better distribution, growth cannot deliver the space governments need to act decisively. It keeps systems running, but it no longer sets them free. If growth only maintains balance instead of expanding freedom, what finally forces governments to change course? In the past, growth acted as a shock absorber, allowing economies to recover from crises without deep structural damage. Temporary setbacks could be offset by expansion, rising incomes, and renewed investment. Today, that buffering role has weakened. When shocks occur, whether from financial stress, geopolitical tension, or supply disruptions, growth no longer provides enough momentum to absorb the impact. Instead of rebounding quickly, economies struggle to regain footing. This happens because growth now operates on thinner margins. Productivity gains are limited, labor markets are constrained by demographics, and debt restricts policy responses. As a result, shocks leave longer-lasting scars. Governments attempt to stabilize conditions, but their tools are less effective and more costly. Recovery becomes uneven and incomplete. Businesses remain cautious, delaying investment even after conditions improve. Households stay defensive, prioritizing security over spending. Growth resumes, but at a level insufficient to rebuild confidence. This fragility changes expectations. Markets price in higher risk premiums. Policymakers act conservatively. Citizens lose faith that expansion will restore normality. Growth shifts from a healing force to a maintenance function. It keeps systems operating but does not repair damage. This explains why successive shocks feel cumulative rather than isolated. Each one leaves the economy slightly weaker than before. Without growth strong enough to reset conditions, vulnerabilities accumulate. The danger is not immediate collapse, but exhaustion. Economies continue moving forward, but with reduced resilience. Over time, even moderate disruptions become harder to manage. This marks a decisive change in how growth functions. It still matters, but it no longer guarantees recovery. If growth cannot absorb shocks anymore, how do economies prevent damage from becoming permanent? One of the clearest signs that growth no longer solves economic problems is the shift in public expectations. In the past, a return to growth signaled recovery. People expected jobs to improve, wages to rise, and pressure to ease over time. Today, growth can return without restoring confidence. This is because recent experience reshaped how households and businesses interpret economic signals. After repeated crises, people learned that growth does not guarantee stability. Jobs may exist but feel insecure. Prices may stabilize but remain high. Opportunities may appear but feel harder to access. This experience changed behavior. Households became cautious even during expansion, prioritizing savings and debt reduction over consumption. Businesses hesitated to invest aggressively, unsure whether growth would last or policy would remain supportive. This caution feeds back into the economy, reducing momentum. Growth becomes weaker precisely because people no longer trust it. Governments struggle with this shift. Policy messaging that once reassured voters now feels disconnected from lived reality. Announcing positive growth figures does little to ease frustration when living costs and insecurity persist. This expectation gap erodes trust in institutions and data. People stop measuring success through GDP and start measuring it through affordability, stability, and opportunity. Markets respond similarly. Investors look past headline growth toward balance sheet strength and resilience. This reorientation means growth has less psychological power. It no longer anchors confidence the way it once did. Without confidence, expansion loses force. Growth still occurs, but it does not change behavior enough to resolve underlying stress. This is why growth returns can feel hollow. The economy improves on paper, but expectations remain anchored in caution. If confidence no longer returns with growth, what signal would actually convince people that conditions are improving? At its core, growth stopped solving economic problems because structural limits gradually overtook the model that once made expansion effective. Earlier growth cycles operated in environments with abundant labor, expanding populations, rising productivity, and room to build infrastructure. Today, many of those supports are gone or weakened. Aging populations, reduced labor supply, and increased dependency ratios, raising costs even as growth continues. Productivity improvements are harder to generate, especially in service-heavy economies where gains are incremental rather than transformative. At the same time, infrastructure gaps, climate constraints, and geopolitical fragmentation raise the cost of doing business. Growth now has to overcome more friction just to move forward. This means a larger share of economic output is consumed by maintenance rather than progress. Governments spend more to sustain existing systems instead of building new capacity. Companies allocate resources to compliance, risk management, and resilience rather than expansion. Households use income growth to cover higher baseline costs instead of improving quality of life. These structural pressures reduce the leverage of growth. Even when output increases, it does not free resources the way it once did. The model still functions, but with diminishing returns. Each additional unit of growth delivers less relief than before. This is not a failure of growth itself, but a mismatch between expectations and reality. Growth was never designed to solve aging, inequality, debt, and fragmentation simultaneously. As these pressures accumulate, expansion becomes a necessary condition for stability rather than a solution. Understanding this shift is essential because waiting for growth to fix structural limits only delays adaptation. If growth is constrained by structure, what kind of change can actually restore economic flexibility? As growth lost its ability to resolve underlying problems, relying on it increasingly delayed the adjustments economies actually needed. Governments continued framing growth as the answer because it was politically familiar and socially reassuring. Promising reform is risky, but promising growth feels safe. This mindset encouraged postponement. Structural issues such as weak productivity, inefficient public spending, demographic imbalance, and outdated institutions were acknowledged but rarely confronted directly. Growth was expected to buy time. Instead, it reduced urgency. When economies expanded modestly, pressure eased just enough for difficult decisions to be delayed again. Over time, this pattern hardened. Systems adapted to living with unresolved problems, normalizing underperformance. The cost of delay accumulated quietly. Debt rose faster than capacity, inequality widened, public trust weakened. Each cycle of growth delivered less relief than the last, yet expectations remained anchored to past outcomes. This mismatch distorted policy. Governments designed measures to protect short-term expansion rather than enable long-term adjustment. Businesses invested cautiously, unsure whether structural reform would ever arrive. Households adjusted expectations downward, prioritizing security over progress. Growth became a stabilizer, not a transformer. This is dangerous because adjustment deferred becomes adjustment forced. When growth eventually slows or stalls, unresolved constraints surface all at once. Policymakers then face compressed timelines and harsher trade-offs. What could have been managed gradually becomes politically explosive. The risk is not that growth disappears, but that dependence on it crowds out preparation. Growth can support reform, but it cannot substitute for it. When societies treat growth as a solution rather than a window for change, they waste the very opportunity expansion provides. If growth delays adjustment instead of enabling it, what happens when the window for gradual change finally closes? Eventually, economies reach a point where growth no longer functions as a solution, but as a signal. It signals that expansion alone cannot overcome structural limits, rising costs, and constrained policy space. At that stage, continuing to chase growth without reform becomes counterproductive. Governments may celebrate positive numbers, but those numbers fail to change lived reality. Frustration builds because effort no longer delivers improvement. This is the moment when the growth-first mindset must be questioned. Growth still matters, but it cannot substitute for productivity reform, institutional renewal, better distribution, and long-term planning. When societies rely on growth to avoid difficult choices, they lock themselves into stagnation. The alternative is not abandoning growth, but redefining its role. Growth should support adjustment, not delay it. It should be used to rebuild capacity, not just to maintain balance. This requires political courage, clear communication, and acceptance of trade-offs that were previously postponed. Countries that make this shift early regain flexibility. Those that don't find themselves trapped, expanding on paper while falling behind in reality. The end of growth as a universal fix does not mean economic decline is inevitable. It means the rules changed. Stability now depends on alignment between output, productivity, costs, and expectations. Without that alignment, growth feels empty. With it, even modest expansion can deliver real progress. The real question is whether governments and societies are willing to move beyond old assumptions and treat growth as one tool among many, rather than the answer to every problem. If growth is no longer the answer, are governments ready to redefine what economic success actually means? For deeper explanations on how global economies, policy limits, and long-term shifts connect beneath the surface, stay with the channel.